Welcome back to the Deep Dive. Today, we're jumping right into a really big story in the banking world.
That's right. We're looking at PNC Financial Services Group.
Yeah, PNC. They're making some pretty bold moves, aiming to become this massive trillion-dollar bank. Think JPMorgan level.
It's a huge ambition. And their latest move, buying FirstBank, holding out in Colorado for, what was it, $4.1 billion? That's a big step.
Exactly. So we've dug into this, looked at the strategy, the risks, everything, to give you the full picture of what PNC's up to and why it matters.
Let's get into it.
Okay, so first off, PNC. They're not small fry, right? Already 8th largest bank in the U.S.
Correct. Pittsburgh-based, big presence in the Mid-Atlantic, Midwest, Southeast, over 2,000 branches already.
But their CEO, Bill Demchak, he's got this vision, double the bank's size, get to $1 trillion in assets.
Which puts them in a whole different league.
Right. And this FirstBank deal, $4.1 billion for a Colorado bank, seems like proof they're serious. So why should you, listening at home, really pay attention to this? What's the core thing here?
Well, it really comes down to deposits.
Yeah.
Especially low-cost, sticky deposits.
The sticky ones.
Exactly. In today's environment, with interest rates where they are, cheap funding for loans is, well, it's incredibly valuable. This isn't just about getting bigger for the sake of it.
It's strategic.
It's very strategic. It strengthens their balance sheet, makes them more competitive, and honestly, it impacts their valuation down the line. How well they execute deals like this, that really matters for investors. It shows where PNC is headed.
Okay, so deposits are key, but how did this deal actually go down, the mechanics of it?
Sure, so it was a $4.1 billion transaction, a mix of cash and stock.
Targeting FirstBank Holding, which was privately held, right?
Correct. And through this, PNC picks up about $27 billion in assets and nearly 100 new branches.
Mostly Colorado and Arizona.
That's right, really bolstering their presence out west. The deal is expected to close early next year. Then they'll start moving customers over to PNC's systems.
So PNC goes from about $550 billion in assets to closer to $577 billion, getting near that $600 billion mark.
Pushing them up the ladder, yeah. And one detail that caught my eye, no branch closures announced. They're keeping all the FirstBank locations.
Why is that significant? Usually you see consolidation closures.
Well, it sends a really strong message, doesn't it? It says they value the existing customers and communities.
Less disruption.
Precisely. It helps combat that deposit flight phenomenon, where customers get nervous during a merger and pull their money out.
Which regulators watch like hawks.
Absolutely. So keeping branches open suggests a smoother integration strategy. Focus on holding on to those valuable FirstBank customers and their, low-cost deposits.
Okay, so that links back to the deposits. Let's broaden out again the overall strategy. We know the what, we know part of the why. How does this fit into the bigger trillion-dollar picture?
Geographically, it's crucial. PNC was strong east, south, Midwest. This plants their flag firmly out west.
Denver becomes a major hub for them.
A huge hub. They're actually set to be #1 in retail deposits and branches in the Denver metro area post-deal. That's significant market share.
And beyond geography, you keep mentioning the deposits. Loyal, low cost, gold in this rate environment.
It really is. Cheap funding gives them a huge advantage for lending. Plus, it opens up more opportunities in commercial and corporate banking in a pretty dynamic region.
Right, more business banking potential. And I saw something about cultural fit, even down to the orange logos.
Yeah, the orange logos are a fun coincidence.
Yeah.
But the cultural fit part is actually pretty important.
Really? More than just branding?
Oh, yeah. Mergers go much smoother when the banks have similar values like that customer loyalty and community focus both seem to have. It minimizes friction, helps keep employees happy, and critically helps retain those sticky deposits we talked about.
Makes sense. So it helps them build scale to compete nationally.
That's the ultimate goal. This move puts them closer to rivals like U.S. Bancorp, which is around $700 billion, and Capital One at $650 billion. It's a deliberate step towards that national scale.
And driving this is the CEO, Bill Demchak. Tell us about him, ex-JPMorgan guy.
Yeah, he has that reputation. Sharp deal maker. They even nicknamed him Jamie Jr. after Jamie Dimon.
High praise, or maybe pressure.
Maybe a bit of both.
Yeah.
He took over PNC in 2013, grew it significantly. Remember the BBVA USA deal in 2020? $11.6 billion.
Right, that was their first big push west.
Exactly. So he's got a track record. And his vision is clear. $1 trillion through organic growth and deals like this one.
And he just hired a potential successor, Mark Weidman from BlackRock.
That's right. Weidman's mandate seems to be around innovation, partnerships, looking at new areas like private credit,
Yeah.
even crypto. PNC already has a partnership with Coinbase, interestingly.
So Demchak's doubling down on growth, but also looking ahead. Does that kind of aggressive leadership always pay off for investors, though? Especially with all the uncertainty around.
That's the million-dollar or maybe trillion-dollar question, isn't it? Look, strong leadership like Demchak's provides confidence, especially with big M&A. His track record helps.
De-risks it somewhat.
It de-risks it, yeah. But the sheer ambition raises the stakes. He's playing a long game. It demands near-perfect execution.
And bringing in Weidman suggests they know they can't just rely on traditional banking.
Exactly. They need to innovate, look at private credit, crypto, fintech partnerships. The landscape is changing fast. It's a mix of consolidating the old and exploring the new.
Okay, let's place PNC in the current banking hierarchy. You've got the giants, right? JPMorgan at almost $4 trillion.
Yeah, then BofA at 225T, Citi, $1.67T, Wells Fargo, $1.60. Those are the behemoths.
Then the next tier down. U.S. Bancorp, $700 billion. Capital One, $650 billion. Goldman, $600 billion.
And PNC, currently $550 billion, soon to be almost $600 billion with FirstBank. Then you have Truist, BNY Mellon following.
So this deal really does help them close that gap with U.S. Bancorp and Capital One. It cements their position in that tier.
Definitely. And it speaks to a broader trend we're seeing.
Consolidation, why is that happening so much now?
Well, several reasons. Regional banks are finding it tougher, frankly. They're often losing deposits to the really big guys.
And costs are going up? Tech, regulations?
Exactly. Rising costs for compliance, technology upgrades. It's hard to keep up without scale. Plus, you've got competition from non-banks, now fintech, private markets, crypto firms eating into their traditional business.
So banks like PNC, who have the resources.
They're seen as natural consolidators. They have the balance sheet, the strategy, the experience to acquire other banks and gain that essential scale. This FirstBank deal is a prime example.
All right, let's put on our investor hats. Looking at the stock, PNC. You mentioned valuation earlier. The P/E ratio is 13.81. Seems okay.
Yeah, 13.8 PE is generally seen as pretty fair. Not screamingly cheap, but not overly expensive compared to peers, based on current earnings.
But the price-to-book ratio, the PB, is 1.37, and the industry average is closer to 1.02.
Correct. And that PB multiple tells a different story.
What's it telling us?
It tells us the market is giving PNC a premium. It expects PNC to perform better than the average bank, maybe grow faster, generate better returns on its assets, or maybe its assets are perceived as higher quality.
So the market is pricing in success.
Essentially, yes. It's a vote of confidence in Demchak and the strategy. But it also means the pressure's on.
Pressure to deliver.
Exactly. They need to integrate FirstBank smoothly, keep growing, and basically prove they deserve that premium valuation. Any missteps could see that premium erode pretty quickly.
Which brings us neatly to risks. No big merger is risk-free. What are the main watch points here? Integration risk must be top of the list.
Absolutely. Merging IT systems is always tricky. You risk frustrating customers. And keeping that FirstBank loyalty, especially since they're keeping branches open, is critical. Any hiccups there could be costly.
Then there's regulatory risk. Bank M&A gets a lot of scrutiny these days.
It does, and it can be political. Democrats often worry more about branch closures, competition. Republicans might be generally more merger-friendly. But even then, big deals get looked at hard.
Especially a bank growing as fast as PNC. Could they face hurdles on future deals?
Potentially. Regulators might impose conditions, maybe around lending in certain communities, or just generally signal concerns about size and concentration, especially in markets like Denver, where they'll be dominant.
Okay, what about the economy? Rising rates, uncertainty.
That's a big one. Rising rates help margins initially, but eventually they can cool off loan demand, which hits growth. And if there's a wider economic slowdown, that could particularly impact commercial banking out west, right where PNC is expanding.
And finally, just plain execution risk, getting it all done right.
Yep. Wall Street is watching, investors are watching. Given that premium valuation we talked about, if the integration stumbles, if costs overrun, if customer attrition is higher than expected, the stock could take a hit. Flawless execution is pretty much expected.
Okay, so let's try and pull this all together. Key takeaways for you listening.
Right, so big picture. PNC is clearly gunning to be a true national player, not just a super regional. Scale is the name of the game.
And this deal shows how they're doing it targeting growth markets like Denver and, crucially, acquiring those valuable low-cost deposits.
Exactly. So the positives are stronger West Coast presence, $27 billion in sticky deposits, a proven CEO with a long-term vision, and PNC is positioned as a buyer in an industry that's likely to see more deals. Plus, that PE ratio isn't excessive.
But the watch points.
Integration has to be smooth. Expectations are really high because of that premium PB valuation. The regulatory climate is uncertain for future M&A. And of course, the broader economy could throw a wrench in the works.
So it really comes down to this question for you, doesn't it? The PE says it's reasonably priced now, but that PB premium means the market already thinks PNC will knock it out of the park.
Precisely.
Do you believe they'll nail this FirstBank integration and keep marching towards that trillion-dollar goal despite the headwinds? If yes, maybe there's still upside from here.
But if you have doubts about the execution, or worry about the economy or regulators slowing them down,
Then maybe you wait. Wait and see how this integration actually plays out before jumping in. Lots to weigh up with this one.
a complex picture for sure.
Well, that wraps up our deep dive on PNC's big moves. We hope breaking it down like this gives you a much clearer view of their strategy, the opportunities, and the challenges ahead.
Yeah, hopefully you feel well informed about what's happening with this major player. Thanks for tuning in.
Thank you for joining us.
And just a quick reminder, we've shared insights and analysis today, but we aren't certified financial advisors.
That's right. This is all for educational purposes. If you're thinking about making any investment decisions based on this, please consult with a qualified financial advisor first.